Hi, I'm Brett Warren. And the more you know about the most common mistakes that investors make, the greater chances you have of being successful and building longer term wealth. Each week, we do a short series of videos with Michael Yardney about the most common mistakes that we see. Today, we're talking about the difference between investing for cash flow versus capital growth. So, Michael, which is right? I'd love to hear your opinion.
Thanks, Brett. Well, that's a long-standing argument. In the long term, people are wanting to invest to replace their personal exertion income with cash flow, with rent. Fully understand that. But in Australia, residential real estate is a high growth, relatively low yield investment. So I remember years ago when I was sitting with clients, I don't sit with clients anymore now, people would come in and say, Michael, I'd like to buy an investment property so it can pay for my school fees. Michael, I'd like to buy an investment property so it can pay for my holidays. Residential real estate doesn't work that way. So I believe what you first got to do is build an asset base and then start to transition to cash flow. You can't save your way to wealth, so you're not going to do it through cash flow alone. Now, cash flow is important. Cash flow is critical. You've got to understand cash flow. It keeps you in the game, but it's capital growth that gets you out of the rat race. So the first stage of your property investment journey, in my mind, is to build an asset base, because once you've got an asset base, you'll have choices. I don't know what's going to happen when the person watching our chat today, Brett's going to retire, whether there's going to be negative gearing or not, whether there's going to be a capital gains tax, whether the government's going to be able to afford to give us a pension, or whether there's going to be a superannuation, or how it's going to work. All I know is if you've built an asset base, you'll have choices, and those choices will allow you to eventually get the cash you want. But most of the assets you're going to own when you retire is not going to be money you've saved. It's not going to be rent that you've collected. It's going to be the tax-free capital growth. So the compounding capital growth will give you choices in the future, Brett.
I think that's a really interesting point you make, because no one's disagreeing that cash flow is critical, but most of our viewers that are listening are probably going to be working in the short term for perhaps the next 5, 10 or 15 years. So they've got that cash flow there. The cash flow comes later with retirement. And I think you made a really good point about building that asset base first. But many property investors are looking for cash flow to supplement their income, to hold their properties. So what strategy should an investor use?
The problem, Brett, is property investment isn't for everybody. You write lots of blogs, I do. We do our videos individually and together. So we're trying to educate as many people in Australia to become property investors. The trouble is you actually need money to get into property investment. You need your own personal exertion income to live off and to supplement your property investments, and to show the banks you've got serviceability and to give you a deposit. And if everyone could buy a property investment, there'd be nobody renting them, and the whole system wouldn't work. Now, that may not sound fair to some people, but I know you had to when you first started off investing 20 years ago. You were in a different job then. You worked hard. You saved a deposit. You had to go and get your loan. I had to the same way as well. So, no, you can't just buy a property and it'll give you cash flow and replace your income. That's just not how it works. The other problem is, if you're going to want to replace your income in the long term, and you can buy some cheap properties in regional Australia that give you cash flow, because you can buy properties in secondary locations where the rent is more than the outgoings, you'll never be able to have a reasonable living getting $150 or $75 or $120 a week from a property in a 2-horse town. So you've really got to build that asset base like we've spoken. Capital growth first, then cash flow. If you've got capital growth properties, high growth properties, the rent will increase also, because if you buy cheaper properties where at the moment start off on day one, you get a bit of positive cash flow. If they're not going to get the growth, the people in those areas, can't afford to push up property values because they can't afford to pay more. Similarly, the tenants are living there not for lifestyle, they're living there because they can't afford to own anything. You're not going to be able to get more rent out of them. The scary thing is your future lifestyle is going to depend upon your tenants and their income. So you want the sort of tenants who go to work every day, put on their clothes, get dressed, earn good income, pay tax, and pay you money. They're in some ways your employee. So you want the best, most affluent employees you can get, and you're not going to get those in cash flow type properties, Brett.
Yeah, look, I think that's a great point. And something else we often talk about, Michael, is the fact that whether it's a cash flow property or negatively geared, that's actually an outcome. So if you are chasing cash flow, there's nothing wrong with that initially, but we can alter that. We can put down a bigger deposit. We can do a renovation. I know a lot of our high net worth clients undertake a renovation or a development to fast track that cash flow. But I think you made a really interesting point. There's no doubt that cash flow is important, but our investors need to build their asset base first and then live off the cash flow later.
You also, thank you, brought up the point that cash flow positive negative gearing is not an investment strategy. It's a result of how you finance it. It has nothing to do with the property. The more you borrow against it, the less your cash flow is going to be. So don't worry about that bit of it. Look for a property that's going to grow in value to give you choices later in life.
Well, that's right. It's about building and accumulating wealth. So as you often say, Michael, the best property for you at the moment is the one that gets you into your next property sooner. The secondary considerations are the cash flow and the other factors involved as well. Thank you very much for explaining that today, Michael. I'm sure our viewers got a lot out of that session. Thanks again for your time.
My pleasure, Brett.